Good afternoon and very welcome to everyone for joining Hardman & Co today at the Investor Forum. My name is Richard Angus and I'm the Head of Business Development here at Hardman & Co. So our forums give investors the chance to hear a company's investment case and question their management. And today we'll be hearing from 4 companies and ending up with a focus talk from our property analyst, Mike Foster. So we'll move straight on to the first company today, which is Shield Therapeutics. So we're delighted to have Anders Lundstrom, Interim CEO, and Santosh Sambag with us today. Shield is a commercial stage pharmaceutical company delivering specialty products that address issues unmet and patients' unmet medical needs. The company was listed on AIM in 2016. So without further ado, I'd like to hand over to Anders and Santosh for the next 15 minutes or so. Thank you.
My name is Anders Lundstrom. I'm an interim CEO for Shield Therapeutics, and I will give you a general introduction to Shield, and Santosh will follow up showing you our latest financial, which is the third quarter, which we released a couple of weeks ago. So we at Shield Therapeutics, we have one commercial product, and the brand name is Accrufer or Feraccru, depending on where in the world you are. It's Accrufer here in North America, and it's Feraccru typically in UK and Europe. It's an oral iron approved by FDA, EMA, and Health Canada, broadly indicated to use in adults with iron deficiency or iron deficiency with anemia. This market is a very, very big market. And the problem we are solving is that traditional oral irons often lead to discontinuation due to intolerable gastrointestinal side effects or insufficient efficacy. In the US, where we co-commercialize with Viatris, that has really catalyzed our commercial expansion and the growth for Accrufer in the US market. We estimate that the peak revenue for Accrufer is around 450 million yearly, and we have very strong intellectual property through 2035. So this is the management team. As a management team, we have extensive commercial, regulatory development and manufacturing experience. We divided in 2 offices. So David and Jackie are in Newcastle, and the rest of us are in an office just outside Boston in Massachusetts. So why is it important to treat iron deficiency? The prevalence is highest in women of childbearing age or patients with different inflammatory conditions like Crohn's disease, ulcerative colitis, or chronic kidney disease. And it can have a significant impact on the quality of life. So symptoms can include extreme fatigue, headache, dizziness, and cognitive impairment. And it's typically caused by malnutrition or malabsorption or bleeding. So what is the problem then with current oral irons? So most oral irons are dissociated in the stomach. That leads to irritation of the intestinal lining and thereby the gastrointestinal side effects. So that those include bloating, stomach pain, nausea, and so forth. So sometimes patients say that actually the side effects is way worse than the actual symptoms of the iron deficiency. And as you can see, it's a large portion of patients who have these side effects, and about 60% of those who experience these side effects actually discontinue treatment. And of course, as a result, there will be a lack of effectiveness. So how do we solve this problem? So Accrufer or Feraccru has a shield around the actual iron molecule, which makes it not being dissociated in the stomach, but instead in the small intestine. So thereby we can avoid most of those gastrointestinal side effects that I just described. So how do we commercialize across the world? So as I mentioned, in the US, we have our own commercial organization, and we collaborate with a large, well-known US company called Viatris. We have about 100 people in a combined sales force across all of the US. So with that, we have a revenue split, and we also have about $30 million available in future sales miles. In Europe, in the UK, Norgine is the company that commercialized the product. Here we receive royalties, and milestone payments for different events. And the next milestone payment we foresee is when we get an approval for the pediatric indication in the European Union and the UK. In Canada, it's CREI Pharmaceuticals we work with. The product was just approved in August of this year, and we anticipate the launch in the first quarter of next year. Again, revenue-based milestones and double-digit royalties on net sales. In Korea, we filed for approval. The review is ongoing, and we anticipate an approval in 2025. Again, mid-teen royalties on net sales. In China, we work with a company called Ask. There we have a bridging phase 3 study ongoing, which we expect to finish sometime in the end of this year, and thereby be able to file during next year and approval in the second half of 2026. Same setup, approval milestones and double-digit royalties on net sales. So this is a snapshot over the US market. So total market in the US is about 12 million prescriptions yearly. We are currently in what is described here as the current market. That is where we have our 100 salespeople. That share of the market is about 1.8 million prescriptions prescribed by around 12,500 healthcare professionals. And as you can see, we after about the collaboration with Viatris is coming up 2 years soon. And we have about 3% market share. So it's still a very, very big opportunity for us to continue to grow, as we have done very nicely over the last 6 quarters. So but that's my last slide. And now Santosh will take you through the numbers that we just released a few weeks ago. Santosh.
Thank you, Anders. And as you can see, we're excited about the opportunity, and there is a large opportunity still that lies ahead of us. We just released our Q3 financials a few weeks ago, and this is a quick summary of what our key business priorities are. Clearly, it's pretty simple. Grow Accrufer, whether it's revenue, prescriptions, or the net pricing or gross to net. Make sure that we have a balance sheet that's strong and operationally flexible so that we can support our near-term and long-term growth ambitions. And then, of course, make sure that we have our product that's accessible to patients across the globe. In Q3, we're excited to report that we saw about 43,500 prescriptions. That represents a 20% growth over Q2 2024, and that resulted in 7.2 million in Accrufer net revenues. From a pricing, we exited Q3 with about $192 net price per prescription, and that was a growth versus 171 that we saw in Q2 2024. So overall, excited about the progress. I'll get into a little bit more detail on the next slide on specifics. From a balance sheet perspective, we exited the quarter with 7.7 million cash on hand compared to 8.1 million in Q2 2024. As you can see, we are managing our burn as tightly as we can. But in addition to that, we announced 3 specific initiatives. The first one was we announced a 10% reduction in our operating base. This is to make sure that we are focused, hyper-focused, I would say, on making sure that Accrufer grows consistently in the United States and manage all of our investments supporting the growth of Accrufer. Number 2, we had an accounts receivable financing in place with Sallyport. We expanded that from 10 million to 15 million. Again, not new money. This is our own money that we collect faster. And number 3, excited about a non-binding term sheet that we signed with AOP Health. They're our largest investor right now for a potential of at least $10 million of new money via a new equity raise. I'll get into the details of that in a couple of slides. The objective is very clear to us. We want to be cash flow positive by the end of 2025. That's the key objective for the company. And then from a global patient access perspective, we reported, excited about reporting the pediatric pivotal trial that showed a pretty highly clinically relevant effectiveness with no AE-related patient discontinuation. So that's pretty good. Again, we're excited about it, but not surprised because this is consistent with what we saw in our phase 3 trials in the adults as well. We expect to file these results with the FDA and EMA in the first half of next year. And we expect to see close to €1 million in total development milestones from our partner, Norgine. in Europe as we go through that process. Digging a little bit deeper into the Aquifer performance in the US, you can see growth across all three key metrics, whether it's prescriptions, revenues, or net price per script. In Q3 2024, 43,500 prescriptions, like I said, that's a 20% growth over the prior quarter and continues to grow. We continue to see that in Q4 as well. Aquifer net revenues, we saw 7.2 million versus 6.9 million. For the curious mind, that's a 5% growth versus Q2 versus the 20% that you saw in prescription. That is predominantly driven by a very technical buying pattern. What we saw was our wholesalers ended up buying more units in the last week of June, which belongs to Q2, instead of the first week of July, which belongs to Q3, predominantly because of the July 4th weekend here in the United States. Adjusting for that, we would see exactly the same growth as we saw in prescription growth, which is 20%. So fundamentally, we are pretty excited about the strength of both revenues and prescription. Similar story on the Aquifer net price per script. We exited the quarter on average with $167 net price per script in Q3, but adjusting for the same challenge that we saw in July, we would be at $192. So we like the direction of travel, 139 going to 171, going up to 192. We are seeing the same trajectory in Q4 as well. So overall, fundamentally, pretty strong business showing growth across all three key metrics. From a balance sheet perspective and cash flow perspective, like I said, our goal is to be cash flow positive by the end of 2025. We already have a $20 million term loan with SWK. They are an amazing partner, and they are being very flexible and nimble as we continue to grow and extremely supportive. So we continue to maintain that as we see ourselves in the near future. The account receivable factoring program that I mentioned, this is with Sallyport. We included them to strengthen our balance sheet earlier this year by adding in a $10 million line. We expanded that. We recently announced that we expanded that to $15 million. AOP Health has been an amazing partner for us. They are our largest shareholder. Earlier this year, we announced the monetization of a China milestone. It was 11.4 million milestone that we expect by the year end 2026. Obviously, that money is more valuable to us today. We monetized that. We received 5.7 million from AOP on the monetization of that milestone. And then, as I said recently, we just announced a potential $10 million equity raise. This is a non-binding term sheet that we signed in with AOP Health. It's a minimum of $10 million of equity. The subscription price in the non-binding term sheet was 4 pence per ordinary share. And the outcome will be AOP will hold greater than 50% of their total issued share capital. And we are evaluating a broader equity offering that may be available to additional investors beyond AOP should that need arise. Overall, I would say a pretty strong quarter, Q3, with strong performance in Q3 in Aquifer. And we've got all initiatives in place to help ensure that we have a strong balance sheet to help us achieve our objective of being cash flow positive by the end of next year. And with that, I'll hand it back to Anders to close.
So in summary, I mean, this is a very, very big market opportunity in the United States where we commercialize on our own. So the partnership we have with Viatris is really driving growth, as you have seen from the numbers just presented by Santosh. We continue to evaluate, of course, global partnerships in other places where we don't have partners today. And where we do have partners, we continue to see steady progress. We have, as you've seen, increased our balance sheet and operational flexibility, and the goal is to be cash flow positive by the end of 2025. So that concludes the formal presentation. Thank you so much.
We've got a number of questions. Some of them might be the opportunity to elaborate on a lot of the statistics that you've put before us in the last few minutes. But I think the inevitable first question is, will the recent US election win for the Republicans have any bearing on your prospects for 2025 and 2026? Which could be another way of saying, did you predict that are politics important to the political outcome? Is it important to your business or is it not?
I can start by answering that. I think the short answer would be no. with the product we have. It would not change in any way. We don't foresee that to change in any way. For instance, the access we have through different plans, being Medicare or Medicaid, for instance, because those are governmental run plans. So I mean, I think I stopped there, because we don't really know if our product is basically, the sales are too small that we would end up being part of price negotiations and so forth. So only the absolute large mega brands that will be affected by anything like that has already been initiated when it was a democratic ruling in this country. Santosh, you want to add anything there?
No, I think you said it right, Angus. I mean, honestly, politics does not have an impact whether a patient has anemia or lack of iron deficiency. So, our product continues to be really, really, really helpful for patients, and physicians are excited about it. So, we hope the politics doesn't have an impact on our business.
Yeah. Okay, thank you, and thank you to Vijay for that question. So, a very specific question, or more specific question here from Oscar. How frequently does an average patient who is not on the product for life require a 12-week course of Aquifer?
It's a very good. Typically, a patient that we see here who are not chronic to the question, they typically are on about 3 to 4 months. That's what we see per year, something like that. It's super individual, but if you look at the average length of a prescription outside the chronic condition, that's about 3 to 4 months.
Okay, so we've got 1 or 2 more questions coming in. So in the interest of time, so from Martin, on the question of the cash buffer, assuming you raise $10 million with AOP, what do you forecast the low point will be for gross cash prior to turning cash flow positive at the end of 2025?
That's a good question, Richard. We haven't provided any guidance on low cash point through end of next year. All we have said is, this 10 million helps us get to being cash flow positive by the end of next year. Keep in mind, those who are in the details of our business, we do have a debt instrument with SWK that does have some liquidity covenants. We don't expect to trigger any of those liquidity covenants with this raise.
Okay, so thank you very much. So we've got a question from Tarek. Basically, you've talked about the increase in the average selling price this year. What do you think is achievable next year, and how confident are you that you can achieve these high prices, and when?
Go ahead, Santosh.
Sure. I believe what we have said in the past about our average net selling price per prescription is we expect to be in around 220 as we exit next year. We are seeing, as you look at exiting Q3, we are already close to the 200 point. So, we feel pretty confident that we are on the right track to getting to 200 plus and close to 220 as we look at next year. We're putting in multiple initiatives as we speak to help improve our pricing profile. Most of the growth that you've seen in pricing has been organic. It's been more coverage by commercial insurance companies as well as Medicaid. And now we are doing some proactive price changes, especially for the prescriptions that we have been handing for free or at a discount, significant discount. So we're making some meaningful changes to those initiatives. Anders, do you want to add anything on that front?
No, it's rather typical when you launch a product in this country that you don't have coverage from day one. It typically takes 6 to 12 months to get decent coverage. It could take years to get to full coverage. So it's not a sort of it's not an on-off effect or anything like that. So that's why you gradually would see an increase in price per prescription over time, which is of course very different from what you would see in Europe, right? So that is it's a natural evolvement typically when you launch a product, and we are soon at the 2-year mark. So and all of this takes time because there's so many different plans, there are so many different pharmacy benefit managers that you actually then have agreements with, and they typically would reimburse you when they see there is demand. So if they don't see demand, they wouldn't reimburse me. And the way to show them there is demand is actually to give away product for free. So it becomes so if you don't do that, you get nowhere. So that is why longer the goes, the price point is likely to go up. Not forever and ever, but we're still quite far away from our list price, if we put it like that.
Okay. Just moving overseas, I suppose, from Sid. Why are you not seeing traction in other territories that you're seeing in the US? And do you have no influence on partners controlling other territories? And is this situation expected to change?
So in general, the only other place where we have active commercialization today is in Europe, which is then run by Norgine. It's a very different situation in Europe, and it's basically based on pricing, where you would get approval for a price or not, and there it is. Either you get it or you don't get it, and that is what's been some of the challenges. I mean, Norgine is doing really well in some markets like Germany, the Nordic countries, and so forth, and is still evaluating if they can get into the market in southern Europe. So that is why, yes, we do have an agreement with them, and yes, we do talk to them, regularly about those things via business reviews that we have with them. But in the end, it's really up to them, and they are putting forward, a good commercial effort. It becomes very different from the US, just because of how actually the pricing mechanism works.
Okay. There's a question here about if you were to do the proposed equity fundraise, what would your shareholder register look like, and would small private shareholders be substantially wiped out? This is from Martin.
That's a good question. Yeah, Santosh, you want to comment?
Yeah, I think like we said in our prepared remarks, with the $10 million minimum equity raise, AOP would now move from, I believe they're at about 40% today, they would move to about 50% when it's all said and done. And I do believe that is the objective from AOP's perspective as well. We are evaluating based on interest whether we can make the same opportunity available to investors beyond AOP, whether they are institutional or retail. And so we want to help retail investors and our other institutional investors who have been huge supporters of Shield over the last multiple years and decades, that we give them an opportunity to participate as well. So we're keeping those options open, but it does have an impact, obviously, to the overall shareholder base, with AOP gaining 50% plus ownership.
Okay, gentlemen, I think we've absolutely just run out of time, so thank you very much indeed. I will start to introduce the second company, which is Windward, where we are lucky to have Ami Daniel here, the CEO and co-founder today, to tell us about the company. Windward is a leading predictive intelligence company fusing its AI and maritime expertise to digitize the global marine industry. And its customers include leading participants such as banks, government agencies, energy companies, and shipping businesses. So I think I'm going to hand straight over to you, Ami, and we'll catch up in about 15 minutes' time. Thank you.
So thank you. It's great to meet you guys. Very excited. So let me take a step back. Ami Daniel, co-founder and CEO of a company called Windward. We're what we believe is the leading maritime AI company in the world. As you know, shipping is all around us. 90% of the world's trade is transported by shipping. Everything you eat, drink, the iron that people build houses from, the oil, obviously, gas and so forth is transported by shipping. The company was founded in 2011, so we're about 13 years old. We're a specialized data provider with an AI-powered platform, a blue-chip company customer base. We've taken the company public in London about 3 years ago. And AI has really been our bedrock, if you will. In the last year, we've extended that to generative AI solutions. We have 3 generative AI products right now with general availability with customers, making real revenue. And I'm going to tell you that story today. Feel free to ask any questions later today. So shipping is old, but AI will transform the industry. These are the drivers of our business. Geopolitical pressure and sanctions compliance. Obviously, President Trump is back. And we believe, actually, strategically, this is very good for our company. Number one, because of the maximum pressure on Iran. I think that's clear. And they would have more requirements. Secondly, because that will provide clarity and consistency in the next 4 years in the U.S. It doesn't matter what their policy is. The House, the Congress, and the President are all led and controlled by Republicans. Decarbonizations, many of our customers already work with us on this, reporting for decarbonization and reducing emissions. Supply chain pressures, obviously, we know now that the Houthis have been added for about a year now. So the Red Sea issues, just this week, I think you had a strike in Canada, another new storm in the Caribbean. So I think that's evident. And obviously AI is transforming the industry. I'd like to highlight that AI is not just transforming the vendor side, which is us, but also the customer side, which is seeing more demand or showing more demand, which is the enterprises. So we have a subscription model which is highly scalable. I believe, according to Canaccord, we're the fastest growing software company in the UK stock market. If you take all of the UK stock market and refine it according to companies with 80% margin, which are growing more than 20% and convert 100% of their cash flow conversion, I think there's 3 companies in all the market, including the main market. We're the fastest growing, which is great. So we're a subscription business. So we sell access to our software. This is our half-year report. So we've grown year-over-year 35% in ACV, which is our annual recurring revenue, which is a great predictor of the future revenue, and 37% on year-over-year revenue growth. We're about 170 team members and more than 200 customers. So obviously, generative AI has taken the world by storm. Since the launch of ChatGPT, we're what's called an applied AI company, which means we build generative AI applied solutions. So we don't build models per se. We use models, combining it with our data to provide customers value. The bedrock of doing that is our data. So we take 4 types of data sources. Number one is public data, which is, for instance, a ship went into a port in Europe. The second is, and somebody puts it on the web. Second is commercial data. So you can buy data from satellites, you can buy data from ship brokers and so forth. The third is private data. Some customers give us their data in order to integrate it into our products, whether it's ownership data or their contracts. The fourth pillar is Windward generated data. It's data we generate ourselves. For instance, 2 ships met in the middle of the sea and transport oil. Nobody gives you that. We combine these 4 data types into our own data feed, and we serve it to our customers, which engage with it. They like it, they hate it, they're happy, they're not happy, and so forth. And they give us feedback every day through the platform. And that is curated by our team and fed back into the models and improves the outcomes. So this virtuous cycle helps our data get better every single day. And the more customers we have, the better our data is. So we use AI to enrich these data layers from raw data into real decision making, from a blip in the middle of the ocean, a weather forecast in whatever port, a news item for a strike, to we combine these together to serve a decision. Should you hire this vessel to move oil? Like we do for many, many customers, 3 energy majors, key miners, key traders in the world, so forth. Or another example, 2/3 of our revenue is public sector. So we combine this data, we enrich it with AI and help our customers understand who is smuggling drugs right now, fentanyl on the way to the United States. And indeed, we have about 18 US federal agencies as customers. Over the last year or so, we've added a layer, our first generative AI product, which is in production, called My Expert. It's a customizable agent. And when I say agent, think of it like a human being, okay? So this human being comes on top of all this data and helps our customers, which are struggling with hiring, onboarding, training. It helps them analyze the data and get to the decision faster. It could save them a day's work in a second. And what this generative AI agent does, and it's an expert, so it's an expert in compliance, or expert in intelligence, or expert in supply chain. We have multiple personas of this agent. It helps them interact with the data and do their work better, faster, and in a more efficient way. And I think we're the first movers in maritime generative AI. As far as I know, we're the only company with general availability products based on generative AI in this market. I think the benefits are clear. We have our own proprietary data, and our data is our advantage in this case. We've been building this in partnership with AWS. We've hosted last week about 15 customers to an executive briefing with AWS, which was great. So it helps us increase our total available market, increase our differentiation, increase our win rates, and actually raise prices for our customers because they get more value. And I think high level, it also allows us to not just use our data, which is what you see on the top left end here, but also now enable the customers to give us and use their data, which we're doing it increasingly. Actually, we have many customers in production with their data in our platform. So that gives another advantage, but another moat, because once the customers are working with us and give us their data, and this is interpreted by the agents and by the AI, actually, I think it's much harder to compete with us, is the value per customer goes up to the roof. My expert, which I think I mentioned, or MAI expert, is the first agent in the maritime world, which is a trademark, and it runs on our proprietary data, but also proprietary knowledge base, which means think of it like a person we send to our own private university in the company. And we make that person really good at what he does because we've been at it for many years now. So we really know what we're doing. And that proprietary understanding that reports these regulations, these nuanced understanding of the world, we teach that person. And now you get to hire that person to work for you for $5,000 a year, which you could hire a person to do this for $100. And then that person gets access to our data 24/7. That's my expert we provide customers. And I think we have only more than 20 organizations already buying it. This is how it looks like. So this is it's a vessel card, which is basically all the ship's data. The customers can press my expert on the top right end here, and it will summarize the vessel insights and tell them, can you hire this vessel to move oil or cargo? It will also screen the internet for adverse media. Is there anything in the media that says that you should or shouldn't do business with this ship? It will also help you, the customer, after you get the analysis and after you screen the media, also create the email, which is the auto generation of the email flow, which will just save you like 30 minutes. So it's a productivity tool that saves you 30 minutes, but it also is an expert that helps you read this and analyze this from an expert perspective. I hope this is a useful demonstration. In terms of use cases and ROIs, it's clear the ROI is from 5x for small organizations to 88x for large organizations. It allows our customers to standardize their communications, their level of executions, and to just grow more. In relation to the results, when we came to market, we say we believe we're going to grow about 20% per year. And what you see here in blue is the ACV growth, which is essentially like ARR. ACV is annual contract value. And you're seeing that over time, over the last few years, 3 years or 4 years, we've been growing the ACV at a CAGR of 31.2%, and the revenue recognition by about 25%. And I think what it shows is the ACV is the best predictor of future revenue. So when the ACV is up 31%, it means the revenue is going to go up as well. So I think this gives us a lot of forecastability, predictability for our revenue, predictability for our expenses and our growth. And I think it's all positive. We're a pure SaaS company. And by the way, we also expense all of our R&D. So we don't capitalize anything in case anybody was wondering. This shows you the story of diversification of the company from a company that in 2019 did business predominantly with governments around the world, to a company that has grown its commercial business, which is the majority of our strategy and investment. I think it's growing quite fast. If you look at our ACV growth between H1 23 and H1 24. You can see an almost 40% growth in worldwide government, 20% in the US, and 41% in commercial. We're seeing that actually growth continue. So I think our commercial strategy, I think, is panning out very nicely. And obviously combined, that gets us to the whatever 37%. I think what you can also see is that we've effectively, if the commercial revenue was 33.6 million in 21, the half year in 24 was 5.5. So it's a pace of more than 11 million per year. So essentially, we've tripled our commercial business in the last 3 years, and obviously grew our RW government business. I want to refer to the growth in the United States government, which has slowed down a bit. I think the US had a bumpy ride in terms of their predictability of the government, their ability to execute. The fact that the Congress and the House were not ruled by the same party, I think it's going the right way now, as far as we can understand. We expect that growth to reaccelerate. This is the number of customers. As you can see, with significant growth in the number of customers, especially in the commercial market, which you can see, I think, in these charts. Earlier in the year, I think last year, we focused on enterprise businesses. So I think we don't expect to see the commercial customers double, because we prefer quantity over quality, I think. We really are trying to optimize the net retention rate number. I think it's going the right way. I think our customers are doing more business with us. I think in Q2, if I remember correctly, 50% of the new revenue was existing customers. So it's all good. I think once you acquire a customer, you want to grow together with them. These are the operating results. I think effectively you'll see in H1 the EBITDA loss dramatically reduced. So we committed to the market that we're going to be run rate break even at the end of this year, which we're confident we're going to be. You can see the EBITDA loss in H1 going to 1.3 million, so reduced by whatever 70%. So you see the revenue going up significantly year over year, but the expenses not significantly going up. And I think going forward, that's what I think you'll see. We're going to run a profitable company with sustainable growth. We're going to do our best to still stay at the top of the leaderboard chart. This is how you're supposed to look at the company's model long-term on a standalone basis. So the revenue growth is expected to be around 25%. The margins are already upwards than 80%, I think, for the half year and going forward, which is great. It's the highest margins we've ever had. R&D as a factor of overall revenue is going down, as well as sales and marketing and GA, and hopefully EBITDA is going up. So this is kind of the model on a long-term basis. I think you can think about another way to think about it is this way: is people we buy data and effectively we make it more than 14x than what we pay them. So if we pay $1, then this year I think we're 30 something. I think that wraps it up. I think overall we are seeing strong growth. Happy and honored to be the fastest growing company in the UK stock market. Margins are up over 80%. Losses dramatically down in H1. You should expect that also for H2, I think, going even down more. Revenue going up. I think it's a hot market. A lot of things are happening. Acquisitions, customers, generative AI opens up our opportunity. We're excited. We're fully funded. We're at it. We'd love to see you as part of our journey. Thank you very much, Richard, for the opportunity to chat.
Well, thank you. It's a fantastic presentation. So let's just go back one step. This is from John.
Sure.
So could you give more details on your patents and your strategy for protecting IP? And I think you could add on a question to that, which is, how do shareholders know whether your IP is actually working in sense of being a good investment in the long term, or how long would they wait to know whether that is the case?
Well, I think it's two different questions. In terms of IP, we have a series of patents. If I take a step back, in the software world, it is not that clear that patents equals protection about IP, because they're not that enforceable. It's not hardware. Okay, so having said that, we do have a strong patent on on the fusion and the process for cleaning the data and connecting it. We were awarded another patent a week and a half ago, and you can Google them. So if you Google our company name and the Office of Patents in the US, you'll see we were awarded another patent last week, I think, or a week and a half ago, for GPS manipulation, which is spoofing, which is very good for our business. Having said that, the best way to look at it is the company growth and the customer base, in my view. And if you have companies like Exxon, BP, Shell, BHP Billiton, Cargill, sorry, not Cargill, BHP Billiton, Vale, Maersk Tankers, Oldendorf, Legentia, Scan Global, these are all blue chip names. They work with our company on a consistent basis. They're growing, they're trusting us. You can look at leadership, which I think you look at our management and our board. And I think you can look at our results, which I think is the most important thing. And I think we've been delivering results and growth. We've upgraded twice to this year our expectations. We still have a month and a half to go. We're very optimistic. That's that perspective. In terms of, is it a good investment? The answer is, if we'll continue to be the fastest growing company in the UK stock market, right now traded about 4x, 3.5 to 4x revenues. I think read the analyst reports and the brokers' recommendations. I believe there are 3 recommendations by brokers. I think it's Zingers, it's Panmore's, and it's Canaccord Genuity. And obviously, make your own mind. My view, margins going up, growth going up, customers doing more is probably a good idea.
Okay, thank you for that comprehensive answer. But from Debbie, we've got a question. What are the limitations on accelerating the growth of your sales and marketing teams? And I think an add-on from another question is, are you growing faster than your customers are able to cope to pay you?
Okay, second question, no. At the history of the company, we don't have any bad debt or bad payments history. So they're able to pay us. I think we're not overspending on R&D, I think, because the way we work with our customers is in partnership. So we come to them with a product, and we kind of co-build the product with them. Actually, the product was launched 3 weeks ago, 2 weeks ago, called Early Detection, was co-built with customers. And the day of the launch, we had 3 paying customers. And there's another product which wasn't launched publicly yet, which we shipped a couple of weeks ago, which also have pre-launch 3 paying customers. So I think it shows you that we work with our customers to buy the products before they're launched, and gives you an indication that we're building the things they want, and are repeatable, by the way, because we want to build repeatable products in the pace they're able to buy. I hope that answers the question, Richard or Debbie.
Thank you. There's an anonymous question. And I will read it out to you. Share-based comp has been around 10% of revenue since 2022, which seems excessive. What drives the requirement for such high US-style share comp?
US-style outcomes. That's the answer. You want top talent? We're, I believe, one of the only generative AI and AI companies in the UK stock markets. You want to be the fastest growing company in the UK stock market? You want to deliver the breakneck pace? Breakneck pace. You want AI engineers. You want the top salespeople. You want the top management. You know, my view, if you can continue growing that way, and we're one of the fastest growing companies in our industry, then you need to retain top talent to do that. And I'm driving people extremely hard because I only care about outcomes. And if I may, Richard, add something. We were the 20th best high-tech company to work for, and we're one of the best employees for 7 years straight. So I think, obviously, our team feels that, which is it's good news for retention.
So staff retention and staff growth is not a problem, basically.
I don't think we want to grow the staff much more, and I don't think it's definitely not a problem. But it's not a problem because it's a focus.
Yes.
I think when you run a company, you're focused, then you probably prevent problems and maybe you create opportunities.
Yeah. Okay. I've got another anonymous question. This is much
more
specific. By how much percentage does ARPU increase by upselling each MAI early detection and advanced intelligence?
Okay, so we've seen the average sales price for a commercial customer in the H1 grow from $63,000 to $70,000, which is good news. So it's about 12% or so. MEI Expert increases the price per user by about 15%, and early detection by about for government customers it doubles it. Advanced intelligence doubles the price per user. That's our expectation, and in other segments it still remains to be seen. So I think these are significant growth opportunities. My goal is to get to the net retention rate up to 120 plus, so we can grow 20% from our existing customers. I think we're on track, and 10+% more from new customers. I think it's achievable in this rate.
Thank you very much. I think we're basically run out of time. Very much appreciate you coming along and talking to everybody. I am basically going to introduce our next company, which is Custodian Property Income REIT. And we're going to listen to what Richard Shepherd-Cross, who's the investment fund manager, has to say. Custodian offers investors the opportunity to access a diverse portfolio of UK commercial real estate opportunities and blend attractive levels of income with the potential for capital growth. So without any more on my part, Richard, very nice to see you again, and I'm handing it over to you.
Thank you very much. I think the last speaker set an extraordinary pace for enthusiasm, so I'm feeling the pressure already. I'm going to talk to you about UK real estate, and most particularly about Custodian Property Income REIT. And our aim is to become the REIT of choice for private and institutional investors seeking high and stable dividends from well-diversified UK commercial real estate. And I'm going to talk to you about three things. We've got 15 minutes and three things to remember: timing, income, and risk. And we'll take those as they come, starting with timing. Now, I firmly believe that we are on the cusp of a recovering market. If you ever needed fair warning that there was an opportunity in real estate, you only have to look at the amount of private equity that is active in the sector at the moment. That private equity has taken companies private: Aberdeen Property Income, Balanced Commercial Property Trust, and they have been active in the direct market as well, buying a £600 million portfolio called Charles Street Properties. And you can see the names on the right. They are all very, very active. Brookfield currently taking out Tritax Eurobox. We've also seen a significant amount of corporate M&A with mergers, UK Commercial Property REIT becoming part of Tritax Big Box, LXI and Secure Income REIT, and Columbia Threadneedle Property Trust all becoming part of London Metric. So real change. But in our bit of the market, the diversified UK portfolios, there are really only 4 trusts remaining: Picton, ourselves, Schroeder, and AEW. And I'm going to tell you why I think that you should consider Custodian amongst that group. In terms of timing, not only do we have private equity very active, we also have the scene well set in the direct market. 2 charts here. On the left, a chart looking at rental growth, looking at the 3 main commercial property sectors. In the black line, industrial and logistics, the blue is offices, and the orange is retail. Now, what you can see that from the early part of this year, we have seen positive rental growth in each and every one of those sectors. Retail has recovered after probably 5+ years in the doldrums with rents falling. We've now got a really firm base from which to see rental growth. Surprisingly, offices are showing rental growth. It's by no means all offices, but the right properties in the right locations. Question: what are the right locations? They're probably core city centres, really good amenity in the immediate surroundings of those buildings, really good amenity within the buildings, and low environmental impact. Those are the sort of buildings that are strongly in demand, seeing real rental growth. And for anyone who's been following real estate over the last 10 years, they will have known that the star of the show has been industrial and logistics. And while there is still rental growth in that sector, the rate of growth has been slowing, but really positive from an occupational perspective to see rental growth coming through. The second chart that I think is pointing to an imminent recovery is looking at the equivalent yield from property. So that is the yield that takes into account future rental growth. That's the yellow line, and you can see that is forecast to fall, and as yields fall and values rise. And that is being made possible by the expectation of falling interest rates. We've now had 2 cuts in base rate. The views are split, but 3.75% base rate is not unrealistic in 12 months. Those falling rates should lead to capital growth. So when we've got capital growth and rental growth, I don't think it is rash to predict that a recovery should be around the corner. What has this meant for Custodian Property Income REIT? It's enabled us, through growing rents, to increase the dividend by 9% last year, from 5.5 to 6 pence for the year in prospect. And that dividend has grown 5% per annum since 2021. It has seen occupancy rates increase and vacancy rates fall. And our occupancy has gone from 90% to 93.5% over the last 2 years. And like-for-like rental growth for the year to March of 5.6%. And if you look at the chart in the bottom left, that is looking at the rental reversion. So the difference between what we could let all the properties for if we had them vacant and available to let today versus what they are actually let for today. And you can see that chart going back 10 years shows how rental growth has really built into real estate since 2020. And we're currently sitting at the highest rental reversion that we've had for 10 years of trading. So really strongly positive dynamics coming from the occupational market to support my view that the recovery is around the corner. This is real estate. So we need to look at real assets and see from our portfolio some of the rental growth that we've delivered in the last 12 months. In our industrial and logistics portfolio, you can see here through lease renewal, rent review, granting what I call reversionary leases, which are sort of early renewals. We've seen rental increases of anywhere between 12 and 64%. So really strong rental growth. But as I said only a couple of slides ago, it's not just about the industrial and logistics sector. We've also seen in our office portfolio really strong rental growth in Oxford, and perhaps that won't be a surprise to you. Oxford has much been in the news with the life sciences boom that is going on in that city, and we settled a new lease at a 58% rental increase over the passing rent, and in city centre Leeds, 45% increase in rent there following a refurbishment. I think the sector to watch is retail warehousing. The picture you can see there, if you've got really sharp eyes, is a Homebase, which you will have read has recently gone into administration. Happily, in advance of that, we have let that property to Wix, and that's shown a 15% rental increase. And I think that is a sector of the market where we will see further rental growth. The out-of-town retail parks, I think, is well set for some strong rental growth, and it makes up over 20% of our portfolio. and even on the high street, which, as I mentioned, it has had a difficult 5 years, strong rental growth in core high street locations. So I think that makes the case for timing. Certainly to me, that makes the case that this is now a good time to invest in real estate, particularly when we look at our own portfolio valuations, which have now been flat since December and actually marginally up in this last quarter. And I think that tells you something about where we are in the cycle. The next thing I was going to talk about is income. And if you invest in real estate, you should be investing for income and you should be investing for the long term, because that's what real estate does. It provides contractual income secured against the lease contracts, and we get the opportunity to increase those rents every 5 years typically. So it's a long-term investment. The compound income returns are really what drive total return from real estate. And what we aim to do with Custodian is to provide access to that diversified UK regional portfolio of smaller commercial properties in an institutional grade package. Why do we buy smaller properties? The answer is hidden in this chart, and I'll explain why. And I said at the start, there are 3 things to remember: timing, income, and risk. But if you only can remember one thing, then remember the next 30 seconds description of what we're looking at on this chart, because it explains why we do what we do. And what it looks at is the transaction yield of properties traded going back to 2000. It's whole market data, and the dark blue line represents the transaction yield or the net initial yield of properties with a lot size of under 10 million, and the light blue line, lot sizes of over 10 million. And what you'll see on the chart is that from 2000 to 2010, when all investors were happy to own large lots, small lots, but they were focused on tenant quality, building quality, and location, there was a margin, a pretty consistent margin of about 65 basis points between those small and large lots. So you could argue that's the risk premium. In truth, some of that is I can't be bothered to manage a large portfolio of small properties, and I can have a simpler portfolio of larger assets. So there's probably a bit of hassle factor in there. Let's call that 15 basis points to keep the math simple, and 50 basis points of risk premium. But since 2010, we've seen that margin open up and to maintain 150 basis point margin since 2010. And it hasn't been because there's been a change in the risk profile of those smaller regional properties. It's been a change in the buying habits of the largest share of the market. Most people pursuing relatively prime, relatively large assets, restricted supply, prices go up, yields fall, and that creates that margin. But if the risk premium is only 50 basis points, yet we're getting 150 basis point margin, then that suggests that we, with our strategy, get 100 basis points of margin for taking no additional risk. That additional margin allows us to pay a higher covered dividend, and it's that covered dividend that drives total return. And when we look back over 10 years, what this chart is showing is Custodian's share price total return to September over 10 years against the grey line, which is the benchmark, which is the FTSE EPRA REIT index. So that is basically the whole listed real estate market. And you can see that Custodian has outperformed positive 55% versus a benchmark of positive 29%. So the first thing to say is positive 55% over 10 years, I'm not that chuffed with. You know, it should be better. But the market is at the bottom of the cycle. If you allowed compounding, if you were reinvesting dividends, that positive 55 is positive 80%. So it really shows the power of income. Why has Custodian outperformed? And the answer is we're all invested in the same market. Our lot size is slightly smaller. Over that time period, yields have compressed, yields have expanded, and no one has delivered any explicit return just through yield compression. But each and every year, we've paid a higher dividend, and that's driven that total return. Finally, and in the last couple of minutes, I'm going to talk about risk. And for real estate, risk is about tenant quality, and importantly, it's about diversification. Our portfolio is broadly spread across the country. You can see the pock-marked map on the right, and it is spread between the principal commercial property sectors, 41% in industrial and logistics, 22% in out-of-town retail, and the other numbers you can read for yourselves. Why are we focused on those two sectors in particular? Because that's where we see the most rental growth, and that is really driving returns at the moment. And the portfolio is broadly diversified by tenant. This shows the amount of rent that's paid by any one tenant in the portfolio, and I think it is unusual to be as diverse as it is. But we have no one property let to any single tenant that represents more than 1.5% of the rent roll. So very broadly diversified, therefore reduced risk portfolio. And neither are we taking tenant risk. This chart shows the Experian credit rating of the tenants in the portfolio, and it'll show you that 81% of our tenants are considered by Experian to be lower than average risk. I'm very conscious I've been speaking very quickly, but time is short, so I'm going to keep going. This chart is looking at the income return over our weighted average cost of debt. The dark blue at the bottom is our weighted average cost of debt. The light blue is the initial income return from the portfolio, with that grey blue on top, showing the reversionary potential. And you can see we're maintaining a very wide margin over the cost of debt. What does that mean? It means that debt is accretive to earnings, the earnings that support the dividends that drive the lion's share of total return. And in terms of our balance sheet position, what's the refinance risk in our portfolio? We have 4 tranches of debt. The first and smallest tranche, £20 million facility with SWIP, 3.94%, which expires in about 10 months' time. Currently paying 3.94%, and with a consideration of where the forward curve for SONIA will be when it comes to that refinance, we don't have a significant refinance risk around there, certainly less than 1% of the current rent roll to meet the additional cost of debt based on current forecasts, and they may well improve. And then we've got a large tranche of longer dated debt running out till 2028, 2032, fixed rate. So a very secure balance sheet, good quality tenants, broadly diversified. So I think we can tick the risk box. And I'm going to conclude by saying that where we are in the market at the moment, it feels to me as though if you invest for income, heads you win and tails you don't lose. So let's consider heads. Heads is interest rates fall. That's good for income-bearing assets. They should rise in value. Plus, you've locked into that high income return. Tails, interest rates stay higher for longer. Well, then the lion's share of total return is going to come from income, and therefore investing for income is still the right way to go. Thank you very much.
Thank you very much. That was fantastically comprehensive. We have a couple of questions. I'm going to start with one which involves looking at the trends in REITs again, which you mentioned to begin with, the consolidation. Just could you, is this from Liz? You've been involved in the current trend of REITs coming together to consolidate their size. What is the biggest lesson you've learned in this operation? What have you learned now that's new that you probably didn't have to think about 2 or 3 years ago?
I imagine the question is aimed at our attempt to merge with
Yes,
Aberdeen Property Investment Trust.
Yeah, I think so.
It's a really it's a very pointed question. In truth, what have we learned? We've learned that you need to have the shareholders on side, and in the end, in the API deal, it came down to 4 of their shareholders not voting for it, despite 80% by number voting in favour of the merger. And those 4 shareholders were all open-ended equity funds. They had been under huge pressure from their unit holders to return cash. and the prospect of a managed wind down and returning cash to shareholders was more than they could resist. What could we have done to sort that out? I just don't know. We did go and see them, and we told them that the quickest way to cash was to vote through the merger, and as it turns out, the portfolio was sold for less than we offered in full and final settlement, whereas what we offered was a higher price and the possibility of upside. So it's something that I think you know it's quite difficult to prepare for that. It felt to me like an illogical decision. But fundamentally, what I've learned is you need to make sure the shareholders are on side.
You have had a lower LTV target than most REITs for many years. Was that driven by your ability to get higher yielding assets, buying low lot sizes, or did the desire for modest gearing come first and foremost from you by how you found the best way to manage your business?
Yeah, definitely the latter. We have absolutely no problem buying as many small properties as we've ever wanted or needed. If you think about the property market, and we invest from Aberdeen down to Plymouth and from Chester across to Norwich, there are many more smaller assets than there are larger assets in that market. We set our gearing at 25% target very, very purposefully, because we were able to start with a clean sheet of paper 10 years ago, looking back as we did at the time to the global financial crisis, which was certainly looming larger in our memories then than perhaps it is today. And for those listed property businesses that went into the global financial crisis with gearing of 40% plus, very, very quickly, the bank was driving the bus and they were merely managers of the bank's assets. For those that went in with lower gearing, they maintained control of those companies throughout the process. And that's really important if you're trying to protect shareholders' interests. It was, of course, incredibly tempting when interest rates were as low as they were to increase gearing, but we were very disciplined. And given the chart I showed you with that margin over the cost of debt, there are plenty of our peers that wouldn't be able to put a chart like that up because they have lower yielding portfolios, relatively higher cost of debt, and there is a much more squeezed margin. And I'm sure any of them in that position would be equally glad that they hadn't overgeared as well.
Thank you. We don't have much time. We've got really time for one more question, but there are more questions which we will pass on to you afterwards to deal with, if that's okay with you. This is a very current question from Colin, and it concerns, given the budget and election news recently, and you've spoken about lower interest rates coming forward, how worried are you that essentially there may be interest rates lasting at a higher level for longer? Or do you think this is just temporary newspaper?
No, I think, I mean, it partly goes to the answer to the last question around gearing. We have always been aware that near zero interest rates was an abnormal state of affairs. I am old enough to remember thinking that wouldn't it be nice if interest rates got to 5%? And it wasn't such a long time ago. So the strategy that we built was designed to work in a higher interest rate environment. So if you take our portfolio initial yield, it is 6.5%, and with reversion, that's over 7.5%, comfortably ahead of the cost of debt. So Custodian works in a higher interest rate environment. The debt remains accretive. Our absolute focus on income is unchanged, and that accretive debt will still support our fully covered dividends. So we are fine with interest rates being higher for longer. In many ways, it might create opportunities as others find it difficult to survive.
Okay, thank you very much indeed for a very comprehensive presentation. Hopefully we'll speak to you again soon. I'll now go into introducing the fourth company that's going to be speaking today, which is EDX Medical. and we're very lucky to have Mike Hudson, who's the CEO, to talk to you. EDX Medical has an innovative approach to translating clinical insights into diagnostic solutions, and it was founded by Mike, along with Sir Christopher Evans, who I'm sure many of you will either know or have heard of. The company listed on Aquis in November 2022. Mike, welcome, and I'm going to pass straight over to you. Thank you very much.
Yep. So we're a company that's in the medical industry. We're integrated now well within that whole healthcare provider network, and we provide what we call digital diagnostics. So these are the diagnostic tools that doctors, health professionals need in order to diagnose, improve the treatment of patients, and they can do that cost effectively with our products. Introducing the background, why is there a need for this? It's also about timing. We've seen convergence of digital technologies over the last decade and a massive explosion of bioscience knowledge coming out from the pharmaceutical industry, from the research communities, and really the convergence of what's happened in bioscience and our understanding of disease and the ability of digital technologies to now analyze that and report it effectively in a timely fashion means that probably today is the moment in time when digital diagnostics really is going to have its day in the sun. Just to recap then, we're focused on the major disease areas, and major in terms of impact on human life, impact on financial budgets, the cost of care, and by getting earlier diagnosis, which I think we're all aware of, you buy more time to treat more effectively with better knowledge. And as a result of that, the providers of healthcare services, whether they be in the public or private sector, get to benefit from delivering better outcomes cost effectively. And clearly, we have the ambition of impacting the major disease areas. So that is cancer, heart disease, and infectious diseases. So these are the three biggest areas globally that are impacting human life and also the economics. And our strategy has been to both develop and supply the best-in-class products for our clients. So many people in the healthcare industry talk about patients and patient benefit and unmet patient need, but we started this journey by looking specifically at the needs of the healthcare providers. And what they needed was more information at the right time to be able to improve the management, whether that be waiting lists, whether that be better survival prospects. And so at the end of the day, the patient inevitably benefits from this. And treatment options can be come from all directions, but our job has been to really give them the tools that provides the information. So we're a products company, but we're also a service company. So the thing that we should note is that we're a very young company, and it strikes me listening to the other presenters today. Business was formed in the very first months of 2022, and we've pursued a strategy of acquisition, of organic growth, and of sort of staged fundraising during our development. And we did a reversal onto Aquis in November 2022, later that year, in order to give us some access to capital, as we were starting to consummate some very large partnerships, and we wanted to be able to bring our products and innovation through that route to market at scale. So we're a rapidly growing company. We're clearly positioned in global markets that are also amongst some of the fastest growing areas of industry that you can find. And we're defined as much by what we don't do as by what we do. Diagnostics covers a very large number of fields of use. We only focus on products that are clinically impactful. So provide doctors and health professionals and insurers with the information they need about an individual's state of health. And we only sell to healthcare professionals. We provide both the physical tests and the data and the analytics, the interpretation, for them to be able to sort of use that data, interpret it, and deliver what we think of as really truly effective personalized medicine. And that drives the patient outcomes. So the patient is obviously the big winner at the end of all of this, but along the way, there has to be strong alignment between the payers and providers. And a lot of medicine is often slow to change. But in this area, I think none of us can have missed how important it's becoming to be able to enable our doctors here and in every other country in the world to have access to the information and the tools to enable them to do a better job. Simply hiring and training more doctors is not going to get us there quick enough. So this is definitely a timing relevant market opportunity. It's also one that for many of the products and technologies that we're using individually, they have been developed, they've been validated, and these are robust industrial strength solutions now. They just haven't been joined up and combined and then really sat down with the user in mind for deployment. So it does mean that we operate our own laboratories, and we're based in Oxford and in Cambridge. Our head office is in Cambridge. And we, as you would expect, at the home of DNA, we run full genomic sequencing ourselves, and many of the tests that we would have been exposed to or heard of during COVID are run routinely in our laboratories. And that allows us to provide products for very different purposes and also at very different price points. And that's important not to ignore the cost of the value of that data. The other thing that I mentioned earlier is that we have really been strongly focused on forming partnerships with companies who we think have a leadership position. So we are a small company. We're 2 and a bit, 3 years old. And we've been able to form some exceptional partnerships with large companies, often which are very mutually beneficial. And that has brought us great strength. It's also given us the capacity to move faster than we might have otherwise thought we'd be capable of doing. And a big driver for that is both access to technologies, which some of these organizations have at scale and therefore cost advantages, but also those that have been working for many years have been able to accumulate the sort of critical clinical data that is so important in being able to use the science and technology that's there at our disposal. So I talk about a partnership that we formed at this time last year with Thermo Fisher, global company, which is providing us with not only access to technology, but great ability to step back in time and look at what was relevant a number of years ago when patients were first being enrolled in trials and studies, and understand how the data might have looked then and compare that with where we are today. So that saves a lot of repeat work. FedEx, I think we all know, but FedEx also run a healthcare specialist division. And when we need to bring samples from the furthest outposts in parts of Europe and get samples back to the airport at night and into our laboratories or partners' laboratories the following day, FedEx have even been flexible enough to route their vans and change their pickup orders on that scale. So there is a massive emotional and operational commitment from these partners to do a great job for us. And that's meant that as well as developing our own products, and I mentioned we're in partnership with both Cambridge and Oxford universities where we have physical presence and where we've acquired businesses or licensed patents, we've been able to partner with companies that are already players in the market where we consider that they've established a gold standard product. And not only that, but they've got literally millions of patient data already. And so compared to what we could generate, or even the whole of the UK with government backing can generate in terms of genomic sequencing and things, which are in the hundreds of thousands of samples. Our partnership with Caris Life Sciences in America, for example, which is the market leader in tumor sequencing and profiling, they already have 4 million patients' data over the last 7 or 8 years. So that's really impossible to catch up from a standing start. So we know when to partner with companies that bring us something exclusive. And from our business point of view and our clients, they can rely on us to provide them with access and also the backup logistics to be able to use these tools effectively. Now, we talked about the laboratory and samples having to get back to our laboratory and doing that really well. But anybody who looks in the healthcare sector will realize that there's a lot of other pressures and changes underway. And part of that is moving towards point of care testing, simplification, smaller, faster, quicker, cheaper. And what that means at the end of the day is if we can do it in our laboratory, we should be the first people to try and take those laboratory assays and reduce them to simpler products that can then be scaled globally, taken through more rigorous regulatory procedures, and then brought to market globally. So our business model really evolves in two stages. The first is refining and developing laboratory assays with our help from Thermo Fisher and others, and getting those running in our own laboratories particularly well. The second stage is, once we've got a grip on that, is to move ourselves into a product development space, take those products, get them through the regulatory procedures and launch them globally to other laboratories around the world. And these are examples of those products which are following on from our laboratory work. So it's a two-stage business model. Our laboratory both generates service income during its formative stages and also is the background work that allows us to develop products. So why would this business, which might sound technically very interesting and might be at the right time, who would you be joining and what's the makeup of the business? So EDX Medical was founded by Sir Chris Evans. Chris and I have known each other since 1976. We're coming up to 49 years of relationships. We've worked together for the last 24 years on something like a dozen private and some public startup biotech companies. And this business is the most recent one for us, and we're in a big hurry. So we've been backed by a great board, colleagues, Trevor Jones, Jason Holt, our chairman, and most recently Eric Vick to join us as commercial officer as we're now starting revenues. And we've been backed by some very well-known private investors and family offices, predominantly UK, but not entirely. But these guys have backed us from the beginning since our reversal onto Aquis, and then subsequently earlier this year when we raised nearly 6 million. So we've raised around 10 million pounds so far since our formation. And have built a business that's now got a substantial portfolio of products, exclusive access, our own products in development, and a robust market access plan that is now being led by Eric with myself to be able to sort of bring those products into the market across the healthcare channels. So we talked a little bit about being at the right time. We're definitely one of the very, very fast movers in this growing market. That is all about being at the right time. It's also about enabling doctors and healthcare providers to get access to the right treatments at the right time, giving patients their individual results they need. And all of this is a very positive environment to be working in. We have been successfully raising finances on Aquis since listing, and that's always been at a premium. And we raised a small amount recently as well, following that same process. We've got a very experienced board and leadership team with great backers. And I think the quality of the business is really exemplified by those international partnerships that we've already been able to form with the likes of Thermo Fisher, FedEx, that ensure that our operational delivery, which is the stage we're now entering into, also meets very, very high expectations. So I'd like to sort of draw a close at that and take questions. Thanks.
What would you say is the most distinctive feature about EDX that investors would like to understand? So I'm not quite sure whether that's suggesting that people really haven't quite got the story yet, or is there a 30-second elevator pitch that you would give people to get them intrigued in order to want to find out more?
I think, we're a healthcare company, not a biotech company classically. So biotech companies are often very binary. They have one breakthrough product that's going to revolutionize the world, we all hope. Our business has got a really strong portfolio strategy, and it's very much customer focused rather than patient focused in the first instant. So this makes us unusual. It's a very commercial organization, therefore, and I think often if people think of Sir Chris and myself with background in the bioscience, biotechnology sector, they'd assume that we've got one blockbuster molecule. This is a portfolio play, and that's very unusual in this industry. So I think that makes our business quite different from most companies that you'll look at if you're looking at biotech investing, certainly.
Okay, so question from Peter, which rather moves on to that, because you're moving very fast. So you obviously have a big ambition, and what limitations do you face?
Mm-hmm.
And maybe you'd like to answer that question, and then based on what you say, there's another question that might follow up on that and be relevant, but you may well cover that in the answer to this one. So let's go.
There might be a clue in the question then. Thanks, Richard. I guess this is a very people-based business, like a lot of business, and I know it's easy to say that, but firstly, people that understand and have the time to understand disease and can get into that are very special people. They're sometimes doctors, they're sometimes scientists, and people who understand the ethics and the issues around sharing that information with people securely, patients, doctors, also have to have a very broad understanding of what's going on. So I would say that building the team of people is always going to be the piece that we have to be very careful about. There's a wide open field of technologies, and we can always assess good and bad technologies and make choices. So that isn't a limitation. But the biggest challenge, I think, for businesses like us is that at the end of the day, I talked about the very large hospital groups, the insurance companies that are going to trust us to find the right products for them at the right price and get them access to them effectively. They've got to trust us. And so people are very important in this organization, I would say. Yeah.
So I think the question was probably moving on to liquidity and cash resources. Does that limit your growth, or the way that you have these partnerships with these massive companies, and you talked about Thermo Fisher, etc., how does it work that basically you can grow very rapidly, but they may have the financial resources to assist you rather than you having to raise the money yourself? Or does it not work like that?
That's a really interesting way. And at the moment, we are financially completely independent from our partnerships, and we work on an arm's length basis through their choice and ours. And I think what we've found, which has been really reassuring, is that those relationships have broadened since we originally conceived them. So the relationship with Thermo Fisher is a good one because originally we wanted to effectively go back in time and get access to some of their data that was off some of their old machines and convert that into the modern era. And they were uniquely positioned to do that and help us one very specific request. But what they realized very quickly was that around the world, there are lots of people inventing ideas in universities, in hospitals, and they've often supplied the equipment or the reagents to them. But they can't manage all of those relationships either. So we end up having to be able to bring those things all together and make it simpler for them to manage, and also simpler for us. So they have quarterly meetings with us, and they can deal with multiple projects, and we can translate those projects in one laboratory rather than them having to cover lots of places around the world. So it's very mutually beneficial. From a financing point of view, we made a plan which set out that we wanted to build a portfolio. We would be taking multiple products through that stage of validating them in our laboratory, turning them into things that can go in boxes and be sold everywhere and pay for the regulatory approval process. And I guess that what we see now is that there is such a strong demand from inventors pushing up and consumers or hospital groups pulling for assets and wanting access to those tests, that we're certainly overblessed with opportunities. at the moment, because that pipeline has really opened up in front of our eyes, bigger than we might have hoped. That does give us the opportunity to scale even beyond our initial ambitions, which were pretty significant. So this is a company that I think now there is certainly corporate venture interest in us, and we're a public company, so we shouldn't say more than that. But those discussions have now recently started taking place, where previously we've kept the trading relationships or the development relationships quite separate from any equity ownership in the business.
This is from David, so it's a follow-on question. It sounds like you already have enough connections and enough shareholders who know you well to fund your growth. Will you be looking for new shareholders?
Well, we recently welcomed one new shareholder, actually from the Gulf, in just a few weeks ago. So that was our second offshore non-British shareholder on there. So that was really nice to see. I think there's lots of reasons why we would be interested in diversifying the stakeholders in the business. Typically where they can bring some additional market access or interest, and we do receive those approaches quite regularly now. So, certainly at the right time and place, that's something that we'll be most interested in being able to entertain.
So by implication, was your new shareholder the latest one? Was someone who approached you, or did you happen to know them already, or how did you connect?
No. They saw us and wanted a piece of the business, and we are on Aquis. There is some liquidity. People can buy shares, obviously, and they can sell them. That's the market. So, but if somebody wants to buy a proper stake in the company the board has the opportunity through Aquis to be able to issue new shares at the appropriate time, and we've done that, previously when somebody brings some value to us as well as the cash, and we've got a particular purpose in mind.
Mike, that's terrific. Yeah. Thank you so much for your time. That's a fascinating presentation. So we are going to basically now move on to my colleague, Mike Foster, who will basically be talking about his thoughts on the property world. Mike has massive experience in this sector. I'm not going to go through his CV for him because it'll take too long. So Mike.
Thank you very much for that intro. And certainly, if you look at the history of it, I was looking forward to mortgage rates coming down to 10%, not 5% when I was younger. So it shows how long ago that is. So I'm going to talk about the real estate sector, but we've been following on from some very, very interesting individual companies. And the theme that I'm going to have when the slides come up, please, would be to invest in individual companies rather than a sector. As I say, it is a talk about property and the real estate sector, but that very much the focus is going to be on we should be looking at individual stocks, because I don't think that we're quite yet at an inflection point for the whole UK sector that means you've got to buy fairly indiscriminately. The REIT sector is going to sort of shoot up straight on from here. This is really following on from a couple of Hardman Forum presentations that I made earlier this year that was looking at a sector where, yes, the volatility of rents and the volatility of asset values and interest rates were all coming down, which is a really good sort of starting point to build value, but that there still wasn't really enough skin in the game, as it were, to go overboard. And I was taking a reasonably negative view, even though, when interest rates turn, that might be seen as a time to pile into real estate. So I'm thinking that base is forming, but that it's too early to yet be indiscriminate, and we've got to look at some very specific situations rather than across the board. Just to put the UK in context, I mean, nearly 90% of REITs globally are quoted in the US. US prices, as we'll see in a second, have actually gone up a bit this year, not massively, whereas UK REITs have gone down. I'd also say that we're looking at a sector rather than specifically REITs, and real estate is run as a real asset, that's the equity, with a long-term view on rents that are backed by real assets. But it also runs on debt. And this can be a friend, a false friend. It can also be a way to invest in real estate. And this shows us in the US how, as I say, that's 90% of the global market nearly. The largest REITs are very different to the large REITs that you've got in the UK. The largest one is a well-known logistics company, but an awful lot of American REITs are actually communications digital infrastructure. American Tower is the second biggest REIT, and the clues in the name. So if you look at the global market, it is fairly dominated by a very different sort of asset to the UK. The UK is a little bit more old-fashioned, looking at offices, retail, industrial assets, and so forth. So I just want to put that in context of looking at the global market. A way to invest in communications is the largest market, which is the US. And we are comparing the US market here and how it's starting. If you look, there's quite a few years of transaction, or rather sort of index history, and the S&P share sector has risen about 9% this year. If you look at the figures, we've got one figure at the end of 2023, and the current year is, as I say, up 9%. But this is driven actually primarily by those communications REITs. So even though we're seeing a US market as a whole for equities that's very buoyant, and we're seeing a REITs market that is starting to slightly rise. If you turn to the next slide and look at the UK market, again, that underperformance of US REITs versus the US market, you've got more underperformance in the UK. So the UK, this is a rather busy slide, and we're looking at the UK market share price of the REITs sector compared to its NAV. So it is a very busy slide, but if you look at the last year in particular, it has been derated further. So this is the share price relative to the NAV. With NAVs falling, share prices have fallen even further. We can see that translated into the index. This is going over the past sort of 7 years or so, but the past year has again seen falls in the sector and in the main share prices. So why is that? If we're seeing a situation where you've got a much steadier situation for rent starting to grow even in retail, and where interest rates are falling. So I think that where we're at is the re-rating is awaiting a real change in interest rates, because if we remember back from what Richard was saying earlier on, the bulk of acquisitions were made at around about 5.5%, 6% net initial yield. A lot of REITs geared up to get what they saw as a sensible return from that 5%, with borrowing money at 2% or whatever, and then getting a total return that was seen as acceptable. Certain REITs that are buying at higher net initial yields didn't have to gear up as much. So that's great news for them, but not such great news for the sector, particularly as the gearing up has meant that the debt lines have started to mature. The REITs have started to have to re-gear themselves with new debt lines, sell things off, find themselves with a net income yield after the gearing that's way too low. So I think that it will take more falls in interest rates to start to have a real impact on the overall UK REIT market. It's more stable. You can start to look at individual situations within that, but having a wider view of let's buy the sector is wrong. So what we need to do is actually look at a wider selection of opportunities. And the derating to NAV, which is sort of fairly across the board, does throw up some very interesting opportunities. We've heard from one earlier on. I mean, Custodian's share price to NAV has been derated over the past several years, and it isn't in a situation where it's overgeared. I'm not here to recommend individual shares. I'm more pointing out that the derating and the start of the change in the interest rate cycle means it's time to start looking at individual situations. The other situation that I mentioned right at the start was that real estate does rely on debt, and that can be a false friend. But there are ways that investors can invest in that debt. Again, as I say, I'm not here to recommend individual stocks, more strategies to look at. And one example is about a 280 million market cap real estate credit investments that invests in debt. So it's effectively a lender to real estate companies, in fact, global real estate companies. There, you've got a situation where the rise in interest rates that's taken place means that they've got scope to, when they are reinvesting in their debt as it matures, to actually get a higher rate of return. So the general rise in interest rates has helped these debt investors. There's lots of details that we can't go into now, but I think it's a point to bear in mind that it's not just REITs that are a way to invest in real estate. There are lots of broader ways to deploy cash. I think that the point to sum up is that we have made a couple of presentations earlier this year where we're saying that it's probably not yet time then to look at REITs very, very actively. We're thinking that now, with the volatility reducing a lot in terms of interest rates, in terms of asset valuations, and with rents starting to go up, it is time to start looking, but that we don't see an across the board massive rise in valuation. We see individual situations, those situations that are not too highly geared, that are investing in assets that generate good income, or looking at the flip side, investing in debt. Those are the sort of areas that we're starting to see real interest. Thanks very much.
So that concludes the presentations, and I'd like to thank all our speakers and you, the audience, for attending this forum. Anyway, once again, thank you very much for everybody. I hope you've all learned something from the forum, and we look forward to seeing you again soon. Thank you and goodbye.